Does that mean we could potentially see a skip in September and a raise in November if the Fed says we want to wait for a little more percolation before we move?
I think it would, as a Fed watcher and a big Fed critic for many years, I think he's been behind. He already skipped once. I think he needs to come out and give you another quarter point, and then if he wants to slow it down. If he slows it down now, then the perception that inflation still will be out there. If you get a big print in GDP or core inflation, which core inflation is still running high, then he's going to be behind, and people are going to expect even greater. So I think he needs to do a quarter. Try to predict what Fed's going to do at times, it's anyone's guess. But we do know the cost of capital is higher. And when you have to discount these high multiple stocks, it makes them worth less. And I would argue that really if you take the market as a whole, it's not that much up. I mean, if you think about it, if an equal weighted basis is up about 5 to 6% for the year. So the majority of this market is concentrated, which means it's vulnerable, especially with high multiple. And I know you mentioned NVIDIA earlier. It's hard when everybody keeps putting so much pressure on these same large cap growth stocks to deliver the market, especially when multiples are rising and interest rates are rising. So we do see the economy having a slowdown, but we see it already starting to take effect. You're starting to see it in spending habits. You're starting to see trade downs. But the market itself, the economy itself, is still very strong, and that's why we think the Fed needs to be a little bit more aggressive.
So, David, given this discussion here, you talked about maybe adding to positions and things where you have conviction right now. But the backdrop, how long could we see and how deep could it be, this pullback that we've been seeing in stocks?
Well, I think that goes back to the point your other guest just made, which is if the economy is softening, if China is exporting disinflation, and outside of housing, there really isn't inflation in the numbers, then why are rates going to go so much higher? I have difficulty with that. Not only that, but remember that while the Fed controls the policy rate, the real interest rate is what matters for the economy, and that's going through the roof as inflation's come down and then the headline rates go up. So I'm not sure the Fed really does have to do a whole lot more. So I think Powell will recognize that the last time we were here, Silicon Valley Bank failed. So if he comes out super hawkish, he could break something. Additionally, you've got real rates going up. You've got the 10-year going up. So the market's doing a lot of tightening for him. I don't think he has to do more. So I actually anticipate that he'll end up being softer at Jackson Hole. But to your point about how much further down do we go, so bullish sentiment, which I look at in the short term, it tells you more than anything, had gotten to about 51, 52% for the retail investor back at the end of July. That was way too high. So we had to have a correction there. We've gotten down to about 35%. Where we want to be is about 20%. So let's say, NVIDIA misses the mark on Wednesday. The AI hype balloon sort of loses some air. That could depress sentiment a little bit more. Maybe, Powell does come out and say something hawkish, which I don't think he will. That could depress sentiment a little bit more. That'll set us up for a year-end rally. Let's not forget that on average, September and this period through the middle of October tends to be sort of lame for the market anyway. Volumes are low. Lots of crosswinds. And so we needed a sentiment reset. That's what we're going through. And let's not forget, we went down 9% back February through March when we had the bank failures and ended up by the end of June being up 19%. So I view this as a regular sort of course of activity for the markets. And I think, again, it's sort of anomalous because there's so much treasury supply coming to market and amidst, weakening demand. So maybe those persist for a long period of time, but I don't think so. And he's right. We are in a 5% world. The equal weight's up 5%. By the way, the corporate bond yield is 5%. You can get 5% on a money market, et cetera. So there are a lot of equilibrium points sort of being met in here. We're going to need a catalyst to ignite things. But I think there'll be a Santa Claus rally once we get the sentiment reset, because earnings are going from here at 220 to 270 over the next couple of years. And that's just going to drive markets higher.